Welcome to the Thanksgiving edition of Econ Updates, where we discuss economic and market issues impacting investing. I'm Steve Taddy, Chief Economist with Hoyle Cohen Wealth Management. First off, happy Thanksgiving, and hope everybody had ample time to spend quality time with family and friends. And a special shout out to Green Bay Packer fans, whose team bested the Detroit Lions in the most played Thanksgiving Day rivalry in NFL history. 22 times these teams have played each other on Thanksgiving Day for our enjoyment. Congrats, Packers fans. Condolences, Lions fans. In the economic news front, the data continues to be supportive of slowing inflation and moderating economic growth. CPI came in flat month over month. Durable goods orders came in flat month over month when you take out the more volatile transportation component, feeding into the narrative that excesses are being wrung out of the system, which is supportive of confidence in the system. Speaking of that, bond yields backed off multi-year highs, settling in at about a 4.5% rate just prior to this broadcast. Spreads, the difference between Treasury bond yields and corporate bond yields, continued to narrow, with the spread being at 15 and 20-year averages, meaning that the risk associated with or perceived with principal payments and interest payments has narrowed. That's a good thing. For valuations on stocks, they rebounded from more recent lows, and the PE is sitting right now at about a 19 PE. Now that's elevated, and it's above longer-term averages for the price-earnings ratio of the S&P 500. But that elevated PE is not shared by other types of stocks in indexes, such as mid-cap stocks, small-cap stocks, international stocks. Mid-cap stocks trade at a 13.5 PE. Small-cap stocks, a 12.5 PE. Large-cap international stocks, also a 12.5 PE. All three of those price-earnings ratios are lower than the S&P 500. And all three are below their own multi-year averages. Now, looking under the hood more of the S&P 500, you can break those stocks into two groups, value and growth. Growth stocks trade at a 21 PE, above, of course, the S&P 500's overall PE ratio, and value stocks trade at a 16 PE, below the 19 PE of the S&P 500 index. Further under the hood, where would the S&P 500 be without the Magnificent Seven? Now, you might have heard that term thrown around. Magnificent Seven relates to the stocks of Alphabet, which is the old Google, Amazon, Apple, Meta, the old Facebook, Microsoft, NVIDIA, and Tesla. Those seven stocks make up 30% of the S&P 500 index. So the S&P 500 price index appreciation, the 18% growth in that index, is attributable, 30% of which, to those seven stocks. If you took out the Magnificent Seven and measured the index with all the stocks having an equal weight, 1/500th of the index, those same stocks or group of stocks would be up only 4%. 18.5% versus 4%, a lot of it due to the Magnificent Seven. And that's okay, because that's where the growth is. If you factor in the price one pays for current earnings, if you factor the growth of those earnings in, this large cap stocks, mid cap stocks, and small cap stocks trade fairly closely together with a ratio that we call in the industry the price to earnings growth ratio. It's not that complex. It's just a measure that it considers the growth of the earnings you're measuring in the price you're paying for that particular stock. In change items for the economy and things that are different today than they were 2 or 3 weeks ago. Gold has risen. Gold is about $2,000 per ounce. Oil has fallen. It's at about $76 per barrel. The dollar has come off multi-year highs against the euro, the Chinese yuan, and the Japanese yen. Commodities in general are a bit lower than they had been in the past, feeding into that narrative of CPI moderating and falling. The forward GDP expectations, the growth expectations for the economy seem to range between 1.75% and 2.25% annualized growth for the fourth quarter of 2023. Forward CPI still seems to be approaching that 2% number come the end of 2024. There's going to be some hiccups in between. We've talked about that before. We have 3 months. We're going to be giving back 0.5% gains in CPI month over month. So all in all, everything is panning out towards that narrative we mentioned earlier in the program: falling CPI, moderating economic growth. The uncertainties that come up from time to time, they're either being resolved or being kicked down the road, which happens a lot with uncertainties. We have a Speaker of the House, yay. We've kicked the can down the road on the budget negotiations till 2024. Not great, but a lot better than having a forced government shutdown because political parties can't agree on a solution to move forward. Anyway, not a whole lot of more new news to discuss. That's where we start the week. Thanks for tuning in.